Hey guys, welcome back to the channel. I'm Andrew, your money mentor, and this is Invest With Me. What we'll be doing on this segment of the channel is basically investing together. I'll be taking all the risks so that you guys don't have to, and we'll get to explore in a safe way what investing really looks like. Any of the losses won't really matter because it's all just my money that we're throwing into this, and if we lose money at the end of the day, at least we're going to be learning something new. But here's the hope, is that we're going to be learning together and investing to hopefully turn a bit of a profit. So grab a notebook, make sure you get down some notes on anything that you learn. This will be a segment that will be hopefully running once a month, where we'll just be putting a same amount, probably $1,000 a month into the stock market to see what happens and what that ends up looking like for us. Quick disclaimer, so I'm not an investment advisor. I don't give financial advice to anyone. I'm an educator, so hopefully this video will provide you with a little bit of insight and also just a bit of entertainment, just to see how the market works, really. So let's dig into it. First thing is jargon. So we're going to be obviously going through the stock market and different investments as a whole. So we're going to be throwing out words that you may not know. If you don't know what it is, easy enough. We can do a quick Google search on it. Hopefully, as I go through the words, I'll just give you a quick rundown of what some of the words mean, especially in earlier episodes, just so everyone is on the same track. Day trading. Will it make me rich? Yes and no, probably not. Realistically, it takes a lot of hours and a lot of experience to get quite good at day trading. It's not for the faint of heart, and if you get emotional about your investments, I would really say to stay right away from it. There's a lot of maths and data and statistics that goes into it, and a lot of experience to actually do it effectively. As a beginner, you're pretty much guaranteed to lose money. So it's not for the faint of heart, and I would recommend staying away from it in the beginning. Realistically, if you look at rich people, they're not day trading. They're not wasting their time day trading. They're letting their money work for them, okay? They're not sitting behind a computer at, 6 o'clock in the morning because they need to be ready for the market in Korea to open or something like that. It's honestly not worth their time, okay? Because the value of compound investments, compound interest and everything, is that your money will work for you more and more and more and become more efficient as time goes on. And that's what we're going to learn about a bit today. So let's go on to compound investment. We'll bring this up here. So compound investment calculator, just so we can have a bit of a look together. All right, so initial deposit is how much money you would put in the beginning. If we put in, say, for example, $1,000 in the beginning, and a regular deposit of $1,000 every month, like what we're going to do in this segment, and the compound frequency would be monthly, number of years, 10 years, annual interest rate, roughly give or take. Markets can be quite low depending on the year, and it can be quite high. Roughly, it's about 10% per annum. That's what you're hoping for, because you're generally going to see over the course of a decade a market double, roughly. Okay, these are estimated numbers. Okay, so be wary of that. I always like to underestimate than overestimate, so I generally would say 8%. Which we can plug in as well to see what the difference is, right, between good years and bad years. So if we put in $1,000 every month for a decade, by the end of a decade, we'd have $200,000, okay? $120,000 is our investment, so the majority of that $200,000 is us putting money in. And then we have $86,000 of interest. If our interest rate was 8%, it drops. So instead of $86,000 of interest, we're now only getting $64,000 of interest. So it's quite a bit less. It starts off very small. So in the first year, it's only $500. And then by the last year, so $50,000 you get in your 9th year in total. From 59 to 64, it's a difference of $14,000. So in your first year, you're only getting $500 of interest, and by the 10th year, you're getting $14,000 of interest. So it gets larger as the time goes on. If we go all the way to, say, 30 years, and you're looking way into the future, which is what you should always do with investing, you can see that that chart really starts to take off quite hard. So the 29th year, our interest total is $1,025,000. To the next year, $1,140,000. So the interest goes from $1,025,000 to $1,140,000, which would be $115,000 interest, right? So that's basically a whole income, as if you're working without having to work. Your money is doing all of that work for you. I understand it's 30 years, but what you need to understand, especially if you're a young person, and I really hope we have young people tuning in to watch this today, is if you are starting from 15 years old, let's say, and you might not be able to put in $1,000 a month. That is quite a lot of money, and a part-time job only gives you so much. But let's say you start from when you're 15 or 16, 17, 18 years old, you finish school, you've gotten a part-time job at 18, 19. The money that you're generating, if you are putting money aside, from 20 years old, 30 years later, you'll be 50. 50 is still quite young. And when you're a teenager, you don't really quite understand how young 50 years old is until you get to 30, 40. This year I'm 30 and the time has flown by. The last decade or so since high school, a little bit over, has absolutely just disappeared. So I can't imagine how fast 50 will come around. And at that point, if I was getting $100,000 a year at 50 years old just for sitting on the couch and doing nothing, that sounds fantastic. And this is one of the things that you need to have in the back of your mind. And realistically, $1,000 a month, it is a bit of money, but it is doable for quite a lot of people, especially if you are on a good income. If you are on a stricter budget and you are saving up for a house, this is something that you need to be a bit more wary of, because you want to make sure that you have all of your guidance in order, sort of thing. So you want to make sure that you have a structure and have a plan. If your house is your priority, save up for that. Put your money aside in a high interest savings account, and just prepare for your future in that regard. You may still want to invest on the side as well, but it doesn't need to be $1,000. You could just pop aside $100 a week or something like that. And when you have enough, then you can invest at that point. All right, so next thing that we're going to be looking at is ComSec. So we're going to be looking at our trading accounts. So if you already have a trading account, let's say it's with ComSec or NAB Trade or another trading platform. If you're American, you'll probably have an account maybe like with Wells Fargo or something like that. If you're European, you'd need to check with your banks and see what they offer. Otherwise, you do have the independent private ones like Robinhood, Webull, eToro, all of those things. Bear in mind, I did mention this in my last video, those ones are not held in your name. So all of those stocks are held by the company, and they're basically saying you own a small portion of it, but it's not actually in your name, it's in the company's name. We're just saying that you own a little bit of it. So that can be something that you might want to just keep in mind if you do go down the route of investing through one of those apps like Robinhood. ComSec though, all of the stocks are owned in my own personal name, which in Australia we have our CHESS sponsorship. So you have your unique holder identification number, which is called a HIN. Your HIN is specific to you. It's not for anyone else. And your stocks are held specifically under your name, under your HIN. So let's type in there we go. Okay, so what do we have so far? Let's have a look at what we've got in our holdings. So all I've done is clicked on portfolio, click holdings here. Now, I've basically just got a really basic account here, assuming some of you may already have a stock or two if you've invested before. If you don't, then this section right here under shares will be completely empty, and that's totally fine. Okay. This is just here so that we can basically run through and have a look at the different bits and bobs and compare a few different stocks. So let's get into it. Global Defense, this is an ETF. An ETF is an exchange traded fund. Big words, and the market will always use big words to try and scare the little people. They don't want you investing. They don't want you in it. They want to make all the money, so they're trying to scare you away from things. Realistically, an ETF is super simple. All you need to know is one company will purchase, say, shares of 100 different companies or 200 companies, whatever it is that they're looking at buying. Once they have all of the shares for those companies, they will create one share. And with that one share, they'll sell out bits of it to people, and you can own a small percentage of all of those companies, right? So instead of having to go out and buy yourself, going to buy 100 different companies, stocks or anything like that, which can be quite tedious and a lot of work, but it also can be expensive. You know, if you're going to put $1,000 into each one, it will end up costing you an absolute fortune. With an ETF, at the end of the day, you could put $1,000 in and it'll give you a tiny little percentage of all of those different companies. It'll be like $20 in each company, or whatever it works out to be. With the ETFs, they do hold, and I don't think they will show it here. No, it's not here. So basically, with an ETF, if you go onto their website, so this one is by Global X and it's called the Defense Tech ETF. If I went onto their website, I would find exactly what is in their stock. So it would tell me number one company, number 2, 3, 4, and it will tell me how much of a percentage they hold. So it's not all even. They don't own 1% of 100 companies. They own a varied amount depending what they want their risk to be. So for example, if a company was investing in the tech sector and they really liked Google more than they liked Facebook, for example, they might buy 10% of their portfolio worth of Google and 1% worth of Facebook or Apple or whatever else instead. So they can vary it, and it is good to check so that you're investing in an ETF that has companies that you specifically like. Next one, Ingham's. Ingham's does chicken nuggets. So all of these I explained in my last video. If you're interested in seeing that, definitely get onto it. I basically just gave the fundamentals of investing and showed everyone how to create a ComSec account. But let's go through this again quickly. So Ingham's is a chicken manufacturer, or I shouldn't really say manufacturer, but chicken breeder and producer, and basically they're the largest producer of chicken in Australia. They're number one. In New Zealand as well, they're number 2, so they are quite a hefty company. They sell to companies like KFC, Subway, McDonald's, Woolworths, Coles, which are our 2 quite large supermarket chains. They don't just own Ingham's as well, they also own Steggles, which are kind of the 2 main frozen chicken bags that you're going to see at the shops when you go to get chicken nuggets or tenders or something like that. You're going to see Ingham's or Steggles as the 2 main competitors, and interestingly enough, they're owned by the same company, so there's that. I do believe that Steggles is also halal certified as well, from my knowledge. So that does also reach an extra market there by having that halal certification. Next one, Treasury Wine Estate. So they produce wines like Penfolds, so premium wines, and that's what they're targeting specifically, is being that premium wine company. They do a lot of exports to China. They recently had some poor exports going to California, which was quite a costly exercise and didn't go so well. They haven't been doing so well lately, partly because of that, partly because there's been a whole bunch of tariffs, whether it's from China, but also from America by Trump and whatnot. So that has made things more costly and more difficult to trade. But also now with the whole dispute with Iran at the moment, I feel like most people are kind of maybe trying to withhold their money a little bit rather than saying, yep, I want a premium, nice bottle of wine. They're sort of holding back a bit. Next one, Zip. So Zip is buy now, pay later. Same thing as Afterpay. So they've got Pay in 4, Pay in 8. So rather than having to pay for a whole thing up front or get a credit card out or whatnot, Zip is just another provider of credit, essentially. The reason why I bought each of these, so the defense tech stock, with all of the unrest at the moment, I just wanted something to hedge my bet a little bit. It also holds interesting companies like Lockheed Martin, which are producers of the F-35, F-22. They're quite amazing planes, and I do also like my video games, so whenever I see a cool plane like that, I'm like, yep, this is awesome. I'll totally fly those around. And yeah, I just think it's a cool company that makes cool planes. Basically, that's the gist of it, really. Not really too much more than that. But there are a whole bunch of other companies involved in there as well. For example, Drone Shield, which is an Australian company. They don't have a large holding of Drone Shield. I think it makes up about 1% of their portfolio. But it's an Australian company that basically creates anti-drone equipment, pretty much. And that's where a lot of the current war is heading, it seems. So it makes sense to invest in that sort of preventative measures. Ingham's, I like the company. I like chicken nuggets and all of that. When you go to McDonald's, KFC, Subway, all the rest of them, and you're eating chicken, you're eating Ingham's pretty much. So if my mentality behind it is, it's always a good idea to pick a company that you use, you enjoy, you think is good, makes a good product. And if I'm going to the store and I'm eating chicken and I'm thinking, yep, this is a good product, realistically, why not invest in it? Treasury Wine Estates, same thing. I like Penfolds. They make a nice wine. They do have other brands under them as well, but Penfolds is their main flagship wine. So that's my reason for that. And Zip, I purchased Zip when COVID was around, and it did quite well back then. It ended up absolutely skyrocketing up to about $12 or something like that, and I bought at around $2. So it was a fantastic return on this company, and the price has gone right back down to where it was at the beginning. So I just really wanted to buy back into it. Next thing, let's have a look. So, all right, so researching stocks, let's have a look over here. So if I click up here on quotes and research, we can click find and filter stocks, or even before that, actually, we can click recommendations, and we can have a look through to see what companies are listed as buys, moderate buys, strong buys, holds. Now, these are all rated by independent companies. So do with that information what you will. I would not put my faith into it. It's always best to do your own research and make sure you know exactly what you're getting into, or talk to a financial advisor so that you can get advice suited for you. But generally, the way that these companies rate it is they'll look at what the price is, they'll look at the price to earnings ratio, which I'll show you just quickly. We'll get rid of this. There's nothing down here. Where are we? Do we have a P ratio? No. Summary. Here we go. Okay, so this company here, Life360, it's basically a company that, here we go, operates as a family connection and safety company. That's going to be too long. Long story short, it's basically GPS tracking for your family so that you can keep an eye on where everyone is. So I can, for example, have Life360 set up for myself, my wife, my dog, my children, and I can know exactly where everyone is. So if someone gets kidnapped, I've got GPS tracking them, making sure that they're safe. This company at the moment, the market cap is about $4 billion. So $4 billion is how much that company is worth in total, okay? It's always a bit of a confusing thing looking at the share price. Do not look at the share price. It really does not mean anything, okay? If a company is worth $4 billion, it's worth $4 billion. The share price does not make a difference whatsoever. This company could be worth $4 billion and they could have out, a bajillion stocks for their company, and it might be, 1 cent per share, for example. If it's 1 cent per share, you're thinking, oh my goodness, it's so cheap. It can go to $1 easily, but it can't really, right? The way that it works is if this is 1 cent per share and the company is worth $4 billion, for this to go up to $1, it would have to go 100 times higher because there's obviously 100 cents in $1, right? That also means this $4 billion would have to go up 100 times, meaning it would be a $400 billion company. That's astronomical. It's not going to have that return. So for the love of God, don't even worry about the share price. Do not look at it. It's going to confuse you. Look at the market cap. Is it a nice big company? This one, yes, 4 billion, huge, great. So they've got a decent management behind them if they're worth that much. PE ratio, that's basically saying if I bought this company at this price, how many years would it take for me to get all of my money back, assuming nothing really changes? And at the moment, it would take about 9.5 years. Okay. What did we say is the average return to double our money? It's going to be about 10 years. So if this is under 10 years, then we're beating the market just by that, assuming nothing changes. Hopefully the company does better in the future, continues to grow and betters itself. But at this point in time, that's a pretty good, well-priced stock. Large companies and established companies, for example, Commonwealth Bank, Microsoft, Google, BHP, whatever you're looking at, Coca-Cola, you're hoping to get them somewhere in the ballpark of 10 to 25 PE ratio. Under 25 would be better. If you can get it closer to 15, fantastic. But something like Microsoft, for example, it's in the tech space. It's probably going to grow more, especially with AI being behind the scenes as well. But yeah, realistically, you're hoping to aim for around about 15. This one here at 9.5 could represent good value. Not financial advice, okay? Don't listen to me for financial advice. Just putting that out there quickly, okay? But these are all just my opinions. This is what I've been learning over time. Now, find and filter stocks. So this can be where you come to if you want to find something you want to invest in. You can click on criteria right here and find what you want to look at. So for example, let's say as a beginner, it could be a really good idea to stay in the top 200 companies, right? So I'm from Australia, we're looking at the ASX. If you're from America, it could be from the S&P 500, it could be from the NASDAQ or something like that, okay? So generally, if you're staying within the top 100, 200, 300 companies, whatever it is, they're up there for a reason. They've done quite well somehow, so it could be worth having a look at them. So if I click on that one, it pops up here and it's already clicked on the yes button. And then I might click on, for example, let's have a look. Here Here we go. Price to earnings ratio, like we were talking about just a moment ago. So let's bring down the P ratio right down to 15. Okay, 15 sounds nice. And perhaps market cap we can put in as well. And for our market cap, large market cap basically means it's a large company. Mid market cap means it's mid-sized company, and small market cap means it could be teeny tiny, right? As a beginner, I highly recommend staying away from small cap companies. I have lost myself quite a lot of money in small cap in my beginning couple of years of investing, just because I didn't really know what I was looking at. So you need to be quite experienced to invest in small caps. So let's have a look what we've got here. So top one up here, Worley Limited. So it's got a 12 PE ratio, pretty good. Price to earnings. Let's have a click on this, look at it closer. So remember, we don't look at the share price, doesn't really matter. That just gives us kind of an indication of where it sits in the general trends of things, okay? And just so we can see, so this company goes all the way back here. That's probably about the year 2000-ish, give or take. And it had quite a good run up, and it's come down, and it sort of kind of settles itself back down around here. So that spike might have just been a bit of a fluke. There might have been something happening around there. And from here, it could represent good value. Reason why I say that is because if your PE ratio is 12.46, remember our golden sort of area, somewhere between 10 to 25, hopefully 10 to 15. So this is sitting right up in there. But along with that as well is we're getting a dividend of 4.81% per annum. So for this year, and this won't be every year necessarily, it depends on the stock. For this year, they're paying out 4.8%. So if I invest $1,000, I'll be getting a portion of that back. I'll be getting 4.8% as a dividend for the year. Now, dividend stability can be important because it means if the company is going to 100% pay out, and for some people it's important. So if you're retiring and you just want a stable income, then dividend stability is important. If you're young and you're not too fussed on it, it doesn't matter as much, but it is always nice to make sure that you've got a stable company. 94%, look, that 6% that it's missing realistically could be because of COVID, could have been because of the GFC or something else. So it might have just been a few years that weren't good years, and so that's why it's missing that. And then down here, you can have a look at what people are buying and selling for. So buyers want to buy at $10.17 and cheaper. Sellers want to sell it at $10.49 and higher. Okay, and it tells you volume, so that's how many stocks. So 500 times this will give you the total value of how many they want to sell. Let's go back. So a company that I was interested in, is it going to let us go back? Here we go. A company that I was interested in is this one right here, Woodside. So Woodside essentially is an energy company. They do oil and gas off of the top of my head. Yep, Australian oil and gas company. The reason why I'm quite interested in this is because in my mind, the way that I see it is as we go into the future, we're going to need more energy. Comparing where we are right now to 20 years ago, for example, technology is so much further. It uses so much more energy. If you look at a computer, for example, my power supply in my computer right now is 1,000-watt power supply. When I was a kid, the computer that my dad had would have been a teeny tiny power supply, which would not even attempt turning on this computer that I've got today. So it's a completely different use case. if we look at things like our fridges, dishwashers, and stuff, we are trying to get more green and use energy friendly appliances. However, the larger the population gets over time, the more houses that are made, the more people that there are around, you are going to use more energy per person. Not necessarily per person, but there are going to be more households per country. So each country will need to consume more energy just purely by the fact that there are more people living within that country. So that's part of my thing behind that. The other side is AI. I think AI is going to consume an absolute ton load of energy. Cars. So at some point, we're going to probably want to get really far away from just dirty fuels. So the cleaner we can go, like gas, I believe is quite a bit cleaner than what crude oil and stuff is. But in the meantime, oil is pretty essential. Like we use it every day for our petrol for our cars. Until we get to the point where oil is being transitioned out and we can move onto other fuel sources, then that's what we're going to use. Another energy type, I guess we could say sector, that I'm looking at is also uranium. That's something I'm interested in because it's sort of a transition plan. I want to invest in the oil and gas in the shorter to medium term, and as a long-term outlook, sort of transition into uranium stocks, as I think they could be actually a decent play just in terms of how green the energy is and how powerful it is. The only downside of it is, let's hope we don't have another Chernobyl, really. But we've made our mistakes. Hopefully we've learnt from them and we can do a bit better. So if you want to buy a stock, this is how you do it. We'll go through the process now. And this will be our first stock that we're going to add together on our portfolio. Okay. So every month we're going to be doing this, just a stock each time. We might throw in a random stock like on top just for fun. But yeah, generally speaking, I'll say we'll probably invest $1,000 a month, just buying one stock a month and seeing what it looks like over the course of a year, 2 years, 3 years, and what happens with the share price. The thing is, when we look at investing, a lot of people always come up and they say, oh, well, how's your, portfolio looking? At any given time, it could be down, and it could be down substantially depending on what you've invested in. It's always good to just stay calm, don't get emotional in any of it. You need to have a plan for yourself and know exactly what you're doing. And yeah, that's pretty much it. You're going to learn as you go. I made a lot of mistakes in the beginning and lost a fair bit of money. I've also learned a lot in that time and made a bit of money. So really, it kind of balances out at the end of the day. It is what it is. But talking to a financial advisor can be really helpful and probably will save you a lot of money in the long term, because they have the experience already there and they can pick something that will be tailored to you as well. But anyways, with this, it's my money at risk, so you guys don't even have to worry about it. You're just getting to see the pros and cons of everything and, what it actually looks like investing. So if we look at Woodside here, so current price, buyers are trying to buy at $30.30. Sellers want $30.42. So we could even just split the difference and meet in the middle. Let's have a look at the volume. So volume is how many stocks they want to buy or sell. So buyers, there's 1,000 stocks straight away ready to go in the morning. And sellers, there's 1,000 to go as well. They're both at their respective prices. But if we look behind that as well, let's say the sellers sell to the buyers and start pushing down on this number here. So there's less and less buyers. Really, after this $1,000 here, there's 95 stocks wanting to be purchased, 33, and then it gets to 3,000. So I would say $30 is really where there's quite a bit of resistance where people are like, yep, I want to buy at that price. And if we have a look here, so you've got 1,000 there, 6,000, 1,500, 15,000, which is massive. So $30.45. That's where heaps of people are wanting to unload right now. And if you have a look at these prices, they're all quite close. 0.42, 0.43, 0.44, 0.45. So they're all within a cent of each other. These ones, it's 0.3, and then it jumps all the way down to 0.23, then 0.2, then 0.16, then just $30 flat. So that jumps all the way down. So really there aren't that many buyers in comparison to sellers. So we could probably even put in a price. Let's have a look. If we limit our order, actually just before we do that, market order. This is basically going to say, when the market opens tomorrow, we're going to buy you at the best price we can. Hopefully we can pick a cheap price for you, but really whatever's going, that's going to be the price that you're buying it at. And you may not like it in the end. Okay, so it's always probably a better idea to limit your order of purchase and set a price that you like. So I could go 30.05, for example, and that way I'm slightly above where this is, and yeah, then we'll go from there. Units, if we click switch, now it's in dollars. So I'm going to buy $1,000. The reason why I'm buying $1,000 is because anything up to $1,000 is $5 as a fee to do the trade. If I go $1,001, then it becomes $10 to trade. On the flip side, I can invest $500, for example, and it'll still be $5 to do that trade. But $5 against $500, I'm going to have to make that money back before I actually turn a profit. Whereas with $1,000, it's a lot easier to, not even think about that $5 trade value and make your return. So we've got $1,000 in to buy. Our stock code is WDS, which is Woodside Energy. We've got our limit price, good to expiry, that expires in pretty much a month from now. And the total price is down here, and that would also include brokerage. The reason why it's under $1,000 is because if it added one more stock on, when the price is $30, it would tick us over into $1,000 and something dollars and ends up costing us $10 for fees. So this is as close as it'll get to $1,000 without going over. So we get the cheaper trade rate, basically. We click review order, double check it. Yep, so we get 33 units and it costs us this much, plus $5 fee on top. And there's our total right there. Okay, we smack submit order, and that's gone through. What happens next? So your order will remain active unless it's executed, expired, or cancelled. So executed means someone sold us the shares, or if we were selling, someone bought our shares. Expired means this expiry date it got to and nothing happened. We weren't able to buy or sell. And cancelled is us cancelling it. When you're buying stocks at night, it won't happen until the next business day, which is Monday to Friday, 10 a.m. to 5 p.m. about that. But I think it stops a bit early, about 4:30, something like that. Yeah, you can cancel at any time, really. You can view your status from the manage order page. A confirmation will be sent to your email address if it's executed. So you'll be sent an email. It'll say, yep, you successfully bought these shares for this price. And it will settle within 2 business days, T+2. So basically T is the day that it was executed, the trade. So if the trade happens on a Friday, let's say, for example, +2 is +2 business days. So you'll have the Friday, the Monday, and the Tuesday. The Tuesday is when it will actually settle. So you need to make sure that you have that amount of money, which in my case is $991.65. I have to make sure that I've got that money ready to go in my CDIA trading account, and then we're sweet. Okay, this is my manage orders. So this is under the trade tab, manage orders, and then I've got my order right here. So it's a buy order for Woodside, 33 shares, and that's the price. It just gives you a bit of the details. Hopefully tomorrow that executes. We'll see what happens. It might not. The price might absolutely skyrocket straight off the starting bell. A good way to kind of check what might happen tomorrow is by going onto Google, typing in, for example, where's my button? S&P 500, and having a look what happens throughout the night. So it hasn't actually kicked off. Australian time, I believe it's maybe 11 p.m. maybe that it opens up at the American market. But the American market does have an impact on the Australian market as well. So if you do want a bit of an idea of what's going to happen if the price will go down, if you look at the American market and it looks quite bad, odds are we'll probably have a pretty poor day on the Australian market as well. So it's just a bit of a heads up. The way that it's looking right now, American market may very well have a little bit of a bad day today, and the price might drop overnight. So hopefully we'll see a small price drop so that, where are we? So that we can get our stock here at $30.05. Hopefully it'll come back a bit for us. If not, we can reevaluate. Watch lists. It's always a good idea to set yourself up a watch list. My 2026 watch list, so I've got the top 4 of the stocks that I own at the moment. Hopefully Woodside is going to be the next one that we get in there as well. But I've got a few others. So Bubs and A2, they're infant formula and also milk. Suncorp, that's just an insurance company and a banking sort of situation. Super Retail Group, they do car parts and whatnot. They've got Super Cheap Auto and a few other companies like that. Fortescue is a materials company. Qantas, I absolutely adore. I just love the planes. I love that they're kind of like a mascot for Australia. They're flying up in the air. You see them, and especially during COVID, where we never saw them up in the air, when everything kind of came back around and the planes went back up in the air, it was so exciting seeing that flying kangaroo up in the air again. And it really kind of hit home a bit. Also, when you fly on a Qantas flight from another country and you return to Australia, having the pilot say to you, what would they say? They'd say something along the lines of, for all the Australians on board, welcome home. That always gives me the tingles, and it really makes you feel kind of connected. So I really like that company. I also don't think that they'd be a company that the government would let go under as well, partly because they're a large company. They should be able to sort themselves out on, the majority of times. If there is a time like COVID where they are really struggling, the government will generally want to keep them afloat just because they are such a good representation of Australia. And then, there's other companies. There's a uranium stock, a NASDAQ ETF as well. So if I wanted to invest in the American NASDAQ markets, which is American tech stocks, I could invest in this. And that way I don't need to worry about all of the hullabaloo investing internationally. Although we will probably set up an international account, because why not? Let's learn how to do that. I haven't done it before. We'll do it together, learn something new. Magellan Financial Group, GQG, and that's it for there. Then I just have a couple of tech stocks as well. So Pro Medicus, Ria Group, WiseTech, and Xero. They've all performed quite poorly lately, but they may represent some good value. So at some point, we'll have a look through these and see what the next one is to buy. Now, wrapping up, let's have a look quickly. Buying a... Okay, so let me bring this over here. Okay, so let's wrap up for today. We will be doing this sort of video once a month where I'm going to be doing some investments. I'm going to be putting my capital on the line so that we can learn new things and see what happens really on the stock market without people saying this is how you get rich quick. This is the reality of investing. Okay, so I want to kind of just break the mold for everyone and show you what it actually looks like to invest. And over the course of a year, 2 years, 3 years, we'll see what happens. Okay, and it may be a good result, it may be a poor result, but it's kind of like a science experiment, really, at the end of the day. We have our hypotheses about what's going to happen, and the reality will be our conclusion. So we will see. I'd love your opinion on what stock we should get next. If it's one of the ones I'm already looking at, fantastic. Tell me why you think we should invest in that one, and we'll have a look at it in the next video. Otherwise, if you have any other suggestions, leave them in the comments below. If you haven't done so already and you liked the video or you're interested in watching a future video, make sure you like and subscribe so you can stay up to date. And yeah, I'm really glad that you joined me for today's video, so I'll catch you next time.
The information provided in this video is for educational, informational, and entertainment purposes only, and does not constitute financial, investment, tax, or legal advice. I'm not a licensed financial advisor, tax professional, or attorney. The content is based on personal opinions, experiences, and research, and is not intended as a substitute for professional advice. Investing involves risk, including the potential loss of principal. You're solely responsible for your own financial decisions. Always conduct your own due diligence and consult a qualified professional before making financial decisions.